And I said, well, it could go up to 90 and come back down to 70. It could be very volatile. And it has been. But my message for you today, and I even have a playlist about this, the message is hold on to your gold and silver for dear life. When it opened, it went straight up to like 81, 82. And then eventually it went up to a high of 84.28. That's the spot price. I've heard though that Shanghai, the physical market, it's a truly physical market over there, Shanghai Gold Exchange.
Markets rarely warn before they break. And right now, gold and silver are flashing signals that most investors are completely misreading. Silver surging toward $90, then violently snapping back. Gold dropping nearly $100 an hour. This isn't normal volatility, it's a regime shift. According to macro analyst Mario Innecco, what we're witnessing isn't price discovery, it's stress. Stress between paper markets and the real, physical world. And if you don't understand what's happening now, you risk being shaken out right before the real move begins.
When it opened, it went straight up to like 81, 82. And then eventually it went up to a high of 84.28. That's the spot price. I've heard though that Shanghai, the physical market, it's a truly physical market over there, Shanghai Gold Exchange. They also trade silver. Price got up to 86. I'm hearing that the over-the-counter market in Asia, Singapore, is trading, well, apparently there's very little offer there. The market is almost like people don't want to sell. I'm hearing that from Just Dario. He's got contacts over there. So as we speak here, the silver is now down $3.46. Yes, it settled at $79.33 on Friday, but don't forget, it went up 10%. So this volatility is going to get even more accentuated the higher gold and silver go. And that's why I've been warning people, unless you leverage and you're a trader, short-term trader, you should hold on to your physical gold and silver for dear life. That could be literally, or of course, if you've got a big stash, you should have it in safe storage with a reputable company, not a bank, of course. And we're going to come to the matter of the bank in a minute. So yes, hold on to your gold and silver for dear life. And sometimes it is scary and frustrating when you see these big moves. And the reason they wanted that to happen was to keep you, the public, away from buying physical gold and silver for that matter. Silver had already been trading as a future. So what I'm trying to say here, they don't want you in gold and silver, because what that means is that you become sovereign and independent. You become your own bank when you have physical gold and silver. But if you get rid of it and you put the proceeds back in the bank, you become beholden to these criminals, really, because unfortunately present day banking system is criminal. Why do I say that? Well, because they are able to create currency and credit out of thin air. They don't have to have reserves.
Silver's explosive run into the low to mid-dollar ADS, followed by sudden, brutal pullbacks, is not a sign of weakness. Innecco argues it's proof of tightening physical supply. Western spot prices briefly touched the mid-dollar ADS, but reports from Asia tell a very different story. On the Shanghai Gold Exchange, a truly physical market, silver was reportedly trading significantly higher than Western prices. In Singapore's over-the-counter market, sellers are disappearing. Offers are thin. People don't want to part with real metal. This is the key warning. Price declines driven by futures markets are becoming increasingly disconnected from physical demand. Volatility, in this environment, isn't a red flag, it's a structural feature of late-stage commodity repricing. As prices rise, percentage swings grow larger, designed to create fear, frustration, and emotional selling. That's why Innecco repeatedly warns. This is not a market for leverage or short-term trading. This is a market that rewards unencumbered ownership of physical gold and silver. He stresses holding metal outside the banking system, not as a preference, but as a strategic necessity. Because when you own physical gold and silver, you become sovereign. You become your own bank. And that's exactly what the system doesn't want. According to Innecco, paper suppression of gold and silver isn't random. It's policy-driven discouragement meant to keep the public dependent on banks that create currency and credit out of thin air. When silver refuses to break lower, pressure shifts to gold. Gold's sudden $100 intraday sell-off is viewed as collateral damage, a desperate attempt to restrain silver's signal. But every wave of paper selling expands the monetary base, making gold and silver more bullish long-term. Meanwhile, real-world demand keeps accelerating. China is preparing export controls. Middle Eastern central banks, India and Russia are accumulating physical metal. The US has officially designated silver a critical mineral. You can't build batteries, electronics, or energy systems with paper contracts. And much of the world's silver has already been lost, trapped inside millions of devices where recycling isn't economical. Mining won't save the market anytime soon. New supply takes years, capital, and permits. Add to that unconfirmed but persistent rumors of stress at a systemically important bank tied to precious metals derivatives, alongside emergency Federal Reserve liquidity injections, and the picture becomes clear. The paper system is fragile, and the disconnect between paper pricing and physical reality is no longer sustainable.
I just saw about an hour ago or so before I went out with Rudy for his walk, they smacked gold down to like 44, 45. Gold was down like almost $100. Why? Well, because I think they're getting desperate about silver. So if they can't push silver further down, they go with gold. That's how these people operate. But all they're doing is throwing more paper at the market. The more paper you throw, the more currency out of thin air. It means the Fed is creating the system. The more bullish it's going to be for gold and silver. You know that China is going to put export controls from the 1st of January. We know that the Middle Eastern central banks, the Indians, the Russians, they're all buying physical silver. And even the US has made silver a critical mineral. So paper won't do anymore. You can't use paper to build solid state batteries. You need the real thing. And they kept silver so undervalued for so long that the supply isn't there outside. And even recycling is really hard because it's still not economical to recycle tiny pieces of silver in millions of, let's say, mobile phones and electrical goods that have, you've put in your drawer. It's not worth it. So a lot of this silver has been lost. And it takes years to develop mining, silver mining. And that's the other thing I wanted to talk about. That's more speculative. And I have exposure to silver miners. And that's going to be very volatile. But as long as you don't leverage yourself, and as long as you don't borrow money to do any of this, and you invest, let's say in the miners, money that you're able to not be so worried about, you will sleep well at night. I mean, last night I stayed up just to see where the market opened. I wasn't going to stay up all night just to look at the price. So that's how it's got to be. While the other thing that's going out there, and these are just rumors, is that some big bank has been in trouble, a systematically important bank. Those are the too big to fail banks. Banks like JP Morgan, Bank of America, HSBC, Barclays. I'm not saying it's any of those, but yeah, apparently the exchange had to liquidate this bank's silver position because they couldn't cover the margin. But this is just speculation out there. There's a lot of that going on. If this actually did happen, we will soon find out. We need to wait until the US market opens, because they're saying here that this happened like in the early hours Eastern time. One is saying here 2:47 a.m. Eastern time, but that was just recently, and this post is from 9 hours ago. But maybe this was from Friday to Saturday. Who knows? But it says the reports are concealing the name of the bank, but it is confirmed that overnight the Federal Reserve was forced to pump another $34 billion into the banking system through its emergency overnight repo facility. This $34 billion is on top of $17 billion, which had to be bumped in 2 days ago on Friday morning. The bank involved is described as one of the largest players in the precious metals derivatives market, blew past every risk limit, breached every covenant, and exhausted every line of credit. So, yeah, we'll have to wait and see if there's any truth to this rumor. But I wouldn't be surprised. I'm not going to speculate which bank it might be. I think it's better not to mention the banks, even though I'm not a fan of these banks. Yes, I suspect we're going to continue to see a lot of volatility in these markets.
The question isn't whether gold and silver will remain volatile. They will. The real question is whether investors are prepared for a world where paper promises fail before physical supply does. Because when confidence in paper breaks, who will still be willing to sell real metal at any quoted price? If this breakdown helped you see the bigger picture, hit like, subscribe, and share it with others watching the metal space. Stay informed, stay disciplined, and I'll see you in the next one.